The only real way to have tax reform is to have spending reform. And the best path to optimize results is to not only have spending cuts, but have targeted tariffs to encourage the reindustrialization of our manufacturing base, but also to have some revenue stream flowing into the government. And we want to start transitioning the government to thinking how we could tax consumption rather than production. As we look here, we got multiple pathways to have tax reform, which once again, the first step is spending reform. The government does not have a revenue problem. It has a massive spending issue. We have structural deficits, but we're not taking advantage of all the things that we have available here. The import base alone is almost $3.5 trillion. By setting some type of universal tariff rate, whether it be 15, 16, 20%, is a obvious pathway to really generate more than $500 billion of revenue, which can help offset, once again, not only just spending cuts, but if we want to abolish specific layers of taxation, specifically the corporate tax. The corporate tax alone, by just slashing it and abolishing it in total, and then when you look at also the flip side of just creating a universal tariff rate, one, that would bring tariffs down for some products, depending on how our reciprocal tariffs are working across the world, but have a global weighted average tariff of 16%. This would make a over $500 billion gain for the government, while also creating the most optimal business environment for corporations here in America, and once again, encouraging FDI or foreign domestic investment. As we see here, the real issue, this first tax is spending, because the government, in order to spend anything, has to have taxes first, and it's going to either spend it via borrowing it and going into debt, unfortunately sometimes printing it through its backstop, the Federal Reserve, or once again through direct taxation. It can't do anything else other than those three avenues. So when you really think about the corporate tax revenue being $470 billion, the revenue pie may be closer to 9 or 10% of the revenue pie. But when the actual budget, what we spend, the actual taxation, it's closer to 6%, depending on what years and how big the deficit blows up, it's closer to maybe 5%. So when you're making a case to have something that's feasible in terms of abolishing taxes, the corporate tax is probably the easiest one to kind of get rid of first to get the ball rolling. So as we see here, we have structural deficits, so close to $2 trillion a year. So we can start shrinking that down. You can't get rid of that kind of deficit overnight. The key is to shrink it down so we can then have a lower debt level, debt load, and then obviously we're making smaller and smaller interest payments, which obviously provide actual budget relief. And then since it is a mandatory item on our federal budget, it would actually lower taxes overall. So what we got to think about is having tariff revenue maximized while minimizing taxing production. It's a balancing act, but it can be done. So we think about if we just continue on the same pathway, we're looking at structural deficits of close to $1.7 trillion. With 6% cuts, we're looking at 1.3, and at 12% cuts, we really want to go with a more of a spending hawk strategy. We can really slash the budget by close to under $1 trillion and almost slash $1 trillion off the top. But that's politically impossible. Sometimes to freeze the budget is politically impossible. But what we can do here, right, if we're looking at these simple strategies of having a 6%, a 12%, and a 26% cut. Why is the 26% cut there? That is the idea of, once again, abolishing the income tax altogether, or at least for people making under $150,000 or below. So it's a really big climb to get there, and you have to cut a quarter of the federal budget in order to not have super hyperinflation, because the problems with Republicans, they want to cut taxes but do nothing about spending, which once again pushes inflationary pressures on the economy. So as we kind of think about our calculator, we set the tariff rate to 16% or even 15%. We're getting a lot of revenue, over $500 billion. We just slashed 6% of the budget. You're getting a $420 billion cut. And from that standpoint, you're actually net positive in terms of actually slashing part of the budget. It's actually not net revenue negative, it's actually revenue positive. And then when you think about how this can help if we continue this trajectory, our debt loads will slowly go down over time. And what will end up happening is, and granted, this has to have major reform. This is just with a slight 6% cut, but debt loads do go down, meaning interest payments go down as well. So our options are pretty clear. The big one is let's eliminate the income tax altogether. Once again, you have to find $2.5 trillion to replace. And you don't want to raise tariffs too high to kind of engage in any type of global trade war and shutting out American business altogether. You're trying to find that happy medium where, yes, you're taxing consumption, but not at a level where it's restrictive. And in order to cut $2.5 trillion, you're definitely going to be looking at actually steep entitlement cuts, which would be politically impossible. The idea of eliminating anything 150,000 and under, taking those citizens off the payroll with the tax rolls, you're going to have to cut it still $1 trillion in spending to make that work. Now, it is possible if you can maximize tariff revenue, and once again, you could probably accomplish it with probably close to a 7% cut. Capital gains is another one that could be real easy to cut because it's about 2% of federal spending. So you can actually abolish the capital gains tax today and raise tariff revenue, and it would actually be, once again, revenue positive. The corporate tax is kind of like the sweet spot because, once again, this can drive economic growth. You're talking about the largest private employers. You're talking about the stock market that would obviously probably experience some type of spike or boom. And overall, you're talking about major domestic investment for future job growth. So the optimal combination would be to eliminate all investment taxes altogether, corporate capital gains and the dividend tax. And what you would have to do is probably have a closer to a 10% cut of spending, along with, once again, having that revenue come in from the tariffs. And you can actually probably get away with probably anywhere from a 3 to 5% cut. Because remember, if we can really optimize tariffs to be over $500 billion a year, slashing spending about 4 to 5% would give us this sweet spot of not really cutting too much of the budget, while, once again, beginning the rollback of eliminating taxes on productive income. So it can be done. The roadmap really isn't too difficult. It all has to start with, once again, spending cuts, just engaging or implementing the DOGE or GAO recommendations and findings, implementing the tariff on our massive import base, and then, once again, the beginning of the abolition of the taxes on productive income. It would be a massive win for the economy, and we could still do that by paying down debt. And once again, it is all about having the optimal business environment.